Hello, very good morning to all. I'm Kelvin here. Welcome to today's Daily Dose of Market Insights. I hope that you guys have a great and restful weekend. Very good morning. Today will be Monday, the 30th of June 2025. And coincidentally, today will also be the last trading day of the month, last trading day of the second quarter, and last trading day of the first half of 2025. So how time flies. So before we start today's gist of the daily dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into today's latest intraday technical outlook that we cover on a daily basis for all the major cross asset classes, ranging from the major US dollar pair, the major stock indices, and the two key commodities asset class, which is gold XAU/USD and West Texas crude oil. Let's have a recap what has taken shape over the last Friday session and as well as over the weekend, and as well as today's key economic data releases and their impact on the various intraday movement of these cross asset classes. So let me start with the performance of the US stock market, which I found it's still to be trading in a very bullish sentiment despite climbing up a wall of worry as we approach that 10 days, I would say 10 days of that 9th of July expiration date of US higher reciprocal tariffs, where the US White House threatened to impose on all its trading partners. So what I could see that this chart on my screen here is the intraday chart of the S&P 500. So the S&P 500 opened very strongly in the US session, and there was a very interesting intraday sell-off that took shape at 1:30 a.m. Singapore time, that means on Saturday, and it lasted for about 1.5 hours, where it bottomed out at the last hour trading session of the US session on Friday, that means at the 3 a.m. mark, and it rallied strongly and closed near the intraday high of the S&P 500, inching upward to a brand new all-time high. So the S&P 500 managed to close at 6,173, so that's above the previous all-time high at the 6,150 handle. So very similar for the Nasdaq 100 as well. So the Nasdaq 100 continues to actually breach fresh all-time high last week. So that was 2 times it managed to hit fresh all-time high last week. So yesterday, on Friday, you also managed to actually bottom up at the 3 a.m. mark Singapore time, this Saturday Singapore time, and managed to shape that mini V-shaped recovery and also close at a fresh all-time high at 22,534. And the top performer on the US session on last Friday was the Dow Jones Industrial Average, where previously it lagged behind, and it's managed to actually see a positive inflow on the intraday basis to make it as a top performer on last Friday US session, where it also did a minor V-shaped recovery. But bear in mind, so far among the major US stock indices, 4 of them, only the S&P and the Nasdaq 100 made fresh all-time high, and the leader, the Nasdaq 100, or I consider as the highest beta among the 4 major stock indices, led the fresh all-time high scaling up at the start of last week, right? So the Nasdaq 100 was the one that first made fresh all-time high, then thereafter followed by the S&P 500, but the Dow Jones still has a bit more room to go before hitting its fresh all-time high. Later I'll share the chart of the Dow Jones Industrial Average. So the Russell 2000 underperformed almost unchanged at 0.02%. So that's comprises of the small cap company. And one of the reasons, let me share with you why the US stock market actually declined on last Friday at the 12:30 a.m. mark on Singapore time, is because of that threat coming out from Trump, where Trump himself actually mentioned on last Friday, where is it? Yeah, so the US president said that he was halting negotiation with Canada in retaliation for Canada's digital service tax and threatened to impose new rate within next week, means this week. So stocks actually sold off, but market seems to be ignoring this as a so-called not only a threat by Trump himself. And you know that in the last few months, Trump tends to at the start he will starts to do this kind of very forceful threat to any countries that doesn't deem that is in goodwill negotiation with the US. Then thereafter, either himself or the country will starts to back down, and things goes back to normal. And indeed, it happened. So, it at the start of today's Asia session over here. Let me share you guys. Yes. So at the start of today's Asia session, about half an hour ago, Canada decided to drop the digital tax that inflated Trump to restart trade talks. So it seems that now Canada decided to back down and so-called extend an olive branch to the U.S. White House administration and restart this trade talks as the 9th of July deadline looms for the expiration date of that higher US reciprocal tariffs, where Trump himself at the end of April decided to give a 90-day pause. All right. So with that, that also created some form of positive feedback loop into the Asia stock market. The top performer being the Nikkei 225 over here. So the Nikkei 225 continues to scale a multi-month high. So this is, I believe, that is close to about a 6-month high already at 1.6% intraday. So the Nikkei 225 managed to see positive bullish momentum after that 6-week plus of consolidation that took shape somewhere around in late April. And what we could see over here is that the Hang Seng index still is in the mode of consolidation, negative 0.5%. Despite we have a positive news economic data release. I would say not really that positive, but not as worse as dim, is the MBS manufacturing and non-manufacturing China data that is out early today's Asia session as well. So let me share with you the data for this key tier 1 Chinese economic data. So the MBS manufacturing PMI, so MBS is the short form for the statistical board in China, which is a governmentally compiled data of manufacturing PMI that constitute more of state-owned enterprises rather than SME. So the MBS manufacturing PMI for June still in the contractionary mode, but it's not deteriorating steeply, because it inched up slightly higher to 49.7, still below the 50% mark. 2 basis point above 49.5 that was printed in the month of May, and within expectation of 49.7. And as for the non-manufacturing PMI, also compiled by MBS, that constitute the services sector in China, continues to grow at a very we call it a tepid pace, not really that fantastic, hovering around the 50 level. So it came in at 50.5, slightly above 50.3 that was printed in the month of May, and slightly above expectation of 50.3. So it's not deteriorating, and neither it's actually growing pretty fast. So that also explains why we're going to see this consolidation that is taking shape in the Hang Seng index in last week, and now stretching into today's Asia session as well. So later we covered more about the Hong Kong 33, which is our platform representing the Hang Seng, which is the instrument in our platform representing the Hang Seng index. Over here, is still holding above a key support level, so that doesn't deem that it may kickstart a minor corrective decline today. All right, so now it's trading at negative 0.5%. The higher beta Hang Seng Tech Index that comprises of the China big tech stocks or company with the likes of Alibaba, Tencent, NetEase, they are almost at the unchanged mark, slightly I would say outperforming the Hang Seng index. All right, over here, and the rest of the other Asia benchmark stock indices continues to be more in the green than in the red. So the Kospi is up. The Kospi, which is the South Korea benchmark index, the Kospi 200 is up by positive 0.75%. The TAIEX is underperforming, down, which is the Taiwan benchmark stock index, is down by negative 0.7, negative 0.75%. The STI almost unchanged, and the ASX 200 which is the Australia benchmark index. So the STI is the Straits Times index, which is the benchmark of the Singapore stock market, benchmark stock index of the Singapore stock market, unchanged. And the ASX 200, which is the benchmark for the Australia stock market, is up at 0.3%. So there are more bullish sentiment than bearish sentiment in the Asia Pacific benchmark stock indices as we are speaking right now, following through that positive feedback loop that is being seen on the US stock market. Despite that, we are still climbing up a wall of worry. That is why we're in the worry, because things could change before the 9th of July deadline hit, which is the end date for that 90 days grace period of US White House administration higher reciprocal trade tariffs against its trading partners. Okay, and also on Friday, the US dollar continues to actually tumble over here. So what we could see, this is the 5-day rolling performance of the US dollar against the major currency as of 30th of June 2025. So the dollar continues to actually weaken. So based on the 5-day rolling performance basis, the dollar is the weakest against the Swiss franc, followed by the sterling dollar, which is the Swiss franc is the dollar is the weakest against the Swiss franc, where the dollar is down by negative 1.75% against the Swiss franc, followed by the sterling, where the dollar is down by negative 1.32% against the sterling, and almost the same momentum as the Kiwi, where the dollar is down by negative 1.3% against the Kiwi, and previously where the yen is being trapped, the dollar yen is being trapped in a sideways range in the last 4 weeks or so, or last 5 or so, is now gaining pace, where the dollar is actually weakening rather quickly against the dollar yen at negative 1.2%. So later I'll share with you what are the technical outlook of the dollar yen. So it seems to us that the dollar yen now is actually shaping a potential bearish exit from that 4-week plus of range configuration, because don't forget, the dollar yen has been lagging behind in the dollar weakness that was seen around 1.5 weeks ago. So if you look at the 1-day rolling performance, taking into account of today's performance, what we could see over here is that the dollar is the weakest against the yen and the Kiwi. So the dollar yen is down negative 0.15% right now against on a 1-day rolling performance basis, and the dollar is the worst performing against the Kiwi at negative 0.2%, which is based on the 1-day rolling performance basis over here. And the reason why the dollar is rather weak is because of market participants now are expecting the Fed to switch to a more dovish tone rather than a wait and see approach that's being portrayed by Fed Chair Powell last week in the semi-annual testimony to Congress, and also in the previous FOMC meeting, where the US Federal Reserve also issued a statement that they are pretty much concerned about inflationary trend picking up due to stagflation risk. Then they did mention about the risk of economic slowdown, where if you look at the US economy right now, there could be signs that in fact the economy has really slowed down and the Fed is late in cutting rates. So what do I mean by that? If you look at last week, key economic data, which was the release of that PCE price index, which is the one of the, I would say that in fact, the favorite inflation trend metrics that the US Federal Reserve monitors for their view about inflation trend, but that is kind of a bit lagging as well, because you know the inflation data, CPI data also is recorded. Whatever that is leading is those soft data like inflation expectation based on survey base or based on market based transacted prices. So what we could see over here is that the core PCE price index on a month-on-month came in slightly hotter than expected. So market is expecting 0.1% month-on-month, same pace as the previous month of April. But on a month-on-month basis, it tick up 1 basis point higher to 0.2%. And we stretch it out to remove the seasonality cyclical factors. On a year-on-year basis, the core PC price index that is stripping out of the volatile items like food and energy also rose slightly higher by 1 basis point to 2.7% year-on-year in May, above 2.6% that was actually printed in the April, and 2.6% was revised slightly higher from the earlier print of 2.5%, and also slightly above by 1 basis point from the expectation of 2.6. So by right, this should be a not so we call it a print that that is pleasing to the US Federal Reserve if they want to actually cut rates. So in fact, the dollar should strengthen instead rather than weaken. But however, part of this core PC, we call it index, it comes up with what I call personal spending. So personal spending, take it as simple as retail spending for the US economy. So we know that services sector constitute close to 3/4 of US economic growth in the last 20 years or so. So if personal spending is not so rosy, that could actually imply weaker economic growth, given that personal spending is part of the services sector activities. So personal spending on a month-on-month basis actually grew negative from a month-on-month negative 0.1%, way below 0.2% that was printed in April. And also what market is expecting is at 0.1% positive. So there is a kind of a erupt U-turn on a month-on-month basis in personal spending. So with this erupt U-turn in month-on-month basis on personal spending US, indicating a weakness in retail spending, which also translate to potential weak growth in the second half that may come in the second half of the year for the US economy, that actually keep the bets alive that the Fed need to be more dovish in the second half of 2025, and that is being expressed by the CME Fed Watch 2. So this CME Fed Watch 2 is we can use a gauge of what market expecting the Fed to do in the next few meetings, as being compiled by the CME Fed Watch 2, taking into account of the transacted data of the Fed funds futures market. That means what is the expectation that the Fed funds futures market traders as being portrayed by their latest price action in the Fed funds futures market. So the target rate probability for the 30th of July meeting, which is the next up and coming next month FOMC meeting, market still assigning a high odds that the Fed will still remain stamped unchanged at 4.25% to 4.5%. So that's a chance of 81% remains the same. But what interesting over here is that as we switch down the road to actually take into account of other expiration month of the Fed funds future contract that coincide with the future FOMC meeting, market now is assigning a high chance that the Fed will bring forward its first rate cut that for 2025 to the September meeting on the 17th of September. High chance of 91% that the Fed will engineer a potential 25 basis point cut, to bring down the Fed funds rate to 4% to 4.25%, and also a rather high chance of 79% chance to take it down much lower by another 25 basis point cut on the 29th of October 2025 meeting. So that should bring down to 3.75% to 4%. And what's interesting over here is that now there is bets that has increased for the Fed to engineer a third cut before 2025 ends. So a rather not really that high chance, but it's above 50%, 58% chance that the Fed may introduce another third cut on the last meeting of 2025, which is the 10th of December FOMC meeting, to cut another 25 basis point to bring it down to 3.5% to 3.75%. So now there's actually a growing probability that the Fed will engineer 3 cuts in 2025, one potentially coming in September, followed by October, then thereafter followed by December before 2025. And so that is much more dovish expectation as being portrayed by the US Federal Reserve in its previous June, or I would say that in its latest meeting in June this month. Right, so that explains to us why the dollar is weakening pretty much on Friday. And also from a technical analysis perspective, like I mentioned last week, the US dollar is at a very critical juncture because it's actually now is breaking below a long-term cycle ascending channel support all the way from the low of May 2000. Let me pull out the monthly time frame. You could see it very clear, all the way down from May 2011 low. So that is what talking about close to I would say 13-year of long-term circular bullish trend. And with the breakdown of that 97.4 that has been seen yesterday, and right now it's seen on Friday, where it also have a weekly close below 97.4. So if you go to the weekly time frame chart, on Friday it closes at 97.25, and in today's Asia session is extending its losses marginally down negative 0.06% at 97.2. So with this weekly close below this long-term key circular support at 97.4, indicates that there is a high probability that the 13-year of long-term circular bullish cycle for the US dollar has ended, taking into account as the US dollar index as a broad-based gauge for dollar strength or dollar weakness. And right now, there's higher chance that we are on the brink of a new multi-week and multi-month decline on the US dollar index that translate to a persistent trend of dollar weakness, not on an intraday basis or on a multi-day basis, but from a longer term multi-week to multi-month perspective. Yes, on the intraday we may see bounces here and there for the dollar, but the longer term trajectory seems to be is on pointing on the bearish side of the story for the US dollar index rather than a recovery side of the story for the US dollar index itself. So with the US dollar index now breaching below a low, and from a technical perspective over here, we also start to see short-term intraday technical indicators in grossly oversold level for gold. So that's explained why gold is actually slightly bouncing up in today's Asia session, trading higher from last Friday close at 3,280, up by 0.2%. So last Friday we have a bearish bias for gold, so it already hit our downside support level, which is 3,250. So later I will share with you what's my latest intraday technical outlook for gold thereafter in a short while. All right, so that potentially sum up today's daily dose of market insight. So what we do over here is that this week potentially we more skewed towards a lot of trade deals, negotiation, news flow, because India will be one of them potentially that could sign a trade negotiation deal before the 9th of July deadline starts, because Indian negotiators now are in US, extending the US stay at trade talks gather pace. All right, one thing potentially to watch out for, which is also the Japan, we call it group, the Japanese negotiation group is also negotiating with US White House administration, but Trump now starting to we call it throw a bit of a tantrum, saying that Mr. Japan is unfair on cars and fruits, keeping the 25% reciprocal tariff. So the market doesn't seem that Trump is going to actually keep that 25% tariff, but rather use it as a threat to actually force the Japanese side of the thing to actually negotiate a deal that is we call it good from better from a US perspective. So that actually also explain why the major Nikkei 225 stock market index, which is the benchmark for the Japanese stock market, continues to inch higher as we are speaking right now, up 1.6%, ignoring that negative news flow that Trump threatens to actually impose on Japan, which is 25% tariff. All right, so that sum up the first segment of today's daily dose. Now let us now move on to the second segment of today's daily dose, which is the intraday technical outlook on these broad-based cross asset classes. So with that, let me expand my screen. Okay, so let us start with the FX market first over here. So let me start with the euro dollar. So the euro dollar continues to trade in a rather firm fashion on last Friday, and even in today's Asia session as well, continue to print a series of higher low. Over here we can see higher low, but trying to probe above the first resistance zone that we highlighted at 1725/1750. RSI continues to be held above this parallel ascending trendline support and also above the 50 level mark, indicating no clear signs of downside momentum as price action consolidate in a series of minor higher low that was being seen on last Friday. Okay, what's over here? Okay, over here. So this could be a potential mini ascending triangle range configuration with the range top at 1750. We know that mini ascending triangle range configuration is a bullish continuation price action chart pattern. So with that, we will still maintain our intraday technical bullish outlook on the euro dollar, maintaining our bullish bias, keeping that similar pivotal support that we have on last Friday at 116.60, given that it hasn't broken above the 1750 range top of this mini ascending triangle range configuration. Only a bullish breakout above 117.50, then if we have an hourly close during the European session, then we could potentially shift our medium short-term pivotal support slightly higher to the 116.80 level. All right, so next resistance level to watch after 117.50 on an intraday basis will be 117.80, followed by 118.10, 118.25. So that is actually the minor resistance area that is being printed out in 3 years ago at around the April to May 2021 minor congestion area, and also a Fibo extension cluster levels as well. Only a bearish breakdown and an hourly close below 116.60 short-term pivotal support level that would invalidate today's intraday bullish bias to kickstart a minor corrective decline sequence again, exposing the next two near-term support level at 116.25 followed by 115.80 before another round of bullish reversal takes shape, potentially because the euro dollar is still trading in a short-term uptrend as it continues to trade above the 20-day moving average after a retest close to it on 19th of June this year. Next up will be the sterling dollar. So the sterling dollar also continues to trade within this kind of a minor range configuration, and it seems to us that is forming a potential minor bullish flag formation, which is also a bullish continuation chart pattern as well over here. All right, so still no change using our Titan short-term pivotal support that we highlighted on last Friday, which is 136.70 short-term pivotal support level. First resistance to watch will be also the upper limit of this potential ongoing minor bullish flag formation, which is the intermediate resistance 137.50. Above 137.50 sees the bullish breakout of this minor bullish flag to expose the next resistance zone on the intermediate basis at 138 figure slash 138.30, followed by 138.70 next, which is the one-time Fibo extension taken from the low of 23rd of June over here. All right, so the hourly RSI also continues to shape a higher low and is now trying to inch back up above the 50 level mark as well, indicating some form of positive bullish momentum. Only a bearish breakdown below 136.70 for the sterling dollar that will invalidate today's intraday bullish bias to kickstart a minor corrective decline sequence, exposing 136.30 slash 35.70 and even 135.30, which is close to the 20-day moving average, before kicking start a potential bullish reversal next as the price action of the sterling dollar continues to trade in the bullish uptrend after the bullish reintegration up above the 20-day moving average on 24th of June. So that's for the sterling dollar. Next up will be the Aussie dollar. So the Aussie dollar, taking a look at the daily time frame chart, we see a very clear bullish breakout on last Thursday, or where it broke out above the upper limit of this complex sideways range configuration that is previously in place since 23rd of April. And last Thursday it did a bullish breakout. On Friday, it consolidated at the pullback at the breakout resistance level, now turns into a pullback support or near-term pullback support at 65.30. And if you look at the previous spring up of the push up, it starts to form a bullish hammer candlestick for the first time, where the range configuration takes shape in April. So that is indeed a very positive sign of the appearance of that daily bullish hammer candlestick near the bottom of the range, and also at the retest of the key moving averages of 50 and 200. All right, so what we could see over here is that we consider last Friday price action as a consolidation after that daily bullish breakout of 65.30 that's been seen on last Thursday. So no clear signs of a failure bullish breakout at this juncture. So for the Aussie dollar, we continues to maintain a bullish bias, and where also the price action on last Friday managed to see a mini V-shaped recovery right exactly at our pivotal support 65.10. We also confluence with the rising 20-day moving average as well. And what I could see is that the hourly RSI now has also starts to form a potential higher low right exactly at the 50 level mark, indicating some form of bullish momentum that is trying to research or revive in the Aussie dollar FX major FX pair from a short-term perspective. So using 65.10 as my short-term pivotal support level, maintain our intraday bullish bias on the Aussie dollar. First resistance to watch will be 65.65. Above it sees the 11th of November 2000 minor swing high area coming in, and also confluence with the psychological level of 66 figure, as well as the 0.764 Fibo extension taken from the low of 23rd of June. Only a bearish breakdown below 65.10 on the hourly basis for today, means the hourly close and the bearish breakdown below 65.10 will negate the bullish tone to see it floating downwards towards 65.80. Below 65.80 sees a deeper minor corrective decline to retest the 50-day moving average and the 200-day moving average, confluencing with the next near-term support level at 64.55/64.40. So that's for the Aussie dollar. Next up will be the dollar yen. So the dollar yen, what I could see over here is that it now trade down below that 20-day and the 50-day moving average after a close retest at the 14520 short-term pivotal resistance that we highlighted on last Friday. And also right now it's now threatening to actually probe the ascending range support that is that is still in place since 22nd of April 2025 low. So that's our close to about April, May, about 8 weeks plus of sideways range configuration. And right now there could be a second probe at the 14390 level. And what we could see is that the hourly RSI now continues to show bearish momentum that is taking shape, where price action got rejected at this parallel descending trend line that is in place, that I drew, where it got rejected on last Friday. And in today's Asia session, it actually breakdown below a parallel support level. All right, so indicating bearish momentum condition still remains intact on the dollar yen. So since it haven't broken down below the 14390 key range support or a key medium term range support level, I don't want to tighten my short-term pivotal resistance to be so tight to today's intraday session high at 144.75. So I will still maintain our short-term pivotal resistance at 145.20 for now. Below 143.90 potentially sees a range breakdown scenario unfolding on the dollar yen, exposing the next near-term support level in first at 143 figure level, which is also the psychological level and minor swing low area of 5th of June and 13th of June. Below it sees a probe at the 3rd of June minor swing low at 142.40 next. Only a bullish reversal and hourly close above 145.20 will negate today's intraday bearish bias to see a squeeze up again towards the top of the range at 146.25, followed by 147.15 next over here. Right. So that's for the dollar yen. And also that also sum up the intraday technical outlook on the major dollar pair. Next up, let us now excuse me. Let us now view the intraday technical outlook on the major stock indices, starting with the Hong Kong 33, which is the representing the Hang Seng Index. So the Hong Kong 33 continues to pull back or consolidate below the previous high of 25th of June at 24,490. So it's still trading above our pivotal support level, which is the rising 20-day moving average. So given that it's still on support, we do not want to flip to a bearish bias. So more likely is in a consolidation phase right now. So to break out of this minor consolidation phase, it got to break out above this minor congestion area that has taken shape since last Thursday and Friday, and also coincide with today's Hong Kong session intraday high, which is 24,270 right over here. So that will be the first resistance level to watch for today. So a breakout above 24,270 will potentially increase the odds of this consolidation and see the revival of the bullish momentum to retest 24,490, followed by the upper limit of this ongoing minor ascending channel that is in place since 2nd of June at 24,850. That also coincide with the medium term swing high area of 18th of March and 19th of March this year. Only a bearish breakdown with an hourly close below 23,880 that would negate today's bullish bias to see it floating down or potentially opening up scope for a deeper minor corrective decline to expose the next support level at 23,690/560. Below it, revisit the rising 50-day moving average and as well as the minor ascending channel support that is confluencing at 23,260 as well. So that's for the Hong Kong 33. Next up will be the very strong Nikkei 225 or the Japan 225 representing the Nikkei 225. it continues to see a very steep sharp up move after that bullish breakout of that former minor medium-term ascending triangle range configuration that was previously in place since 13th of May. And it only did a slight pullback close to the former ascending triangle range resistance, now turns into a pullback support at 38,850. And what we could see over here is that after this pullback, all the pullback has been rather shallow. So what we could see over here is that this also could be a very strong impulsive wave 3 that is being formed on the Nikkei 225 or the Japan 225 over here. So this is a very strong short-term impulsive wave 3 movement, okay, that the Nikkei or the Japan 225 is forming right now with the wave 3 extension target at the 2.618 Fibo extension, all right, taken from the start of the wave 1 at 13th of June. So with that, the resistance level has been hit on last Friday that we highlighted earlier, 40,620. So what I'm going to do is that I will have a rather tight short-term pivotal support level right here, slightly below that much more significant minor dip that is being seen on last Friday US session. And also if we do the start of the wave 2, stretch all the way up to the current intraday high, that also represent close to the 23.6 Fibo retracement as well, all right, over here. So with that, using a tightened short-term pivotal support at 40,185 for the Japan 225, first support level to watch where the minor pullback that may take shape during the European session will be at near today's intraday Asia session intraday low at this 40,620 level over here. All right, so as long as this minor pullback didn't surpass below tightened short-term pivotal support at 40,185, we will continue to maintain our bullish bias on the Japan 225. Resistance level to watch 41,050, above it sees 41,655, followed by 41,980 next over here. And also the current all-time high area that was printed in if you go is at 42,490. If you go to the daily time frame chart over here, that is the all-time high, which is in July last year 2024. So it seems to that right now we're almost coming to one full cycle where the medium-term consolidation has ended, and right now the Japan 225 is potentially en route to retest and even retest the current all-time high 42,490 and even do a bullish breakout above it, given that right now we are in a strong impulsive wave 3 and we have another wave 5 movement to go that is also on the upside potentially based on the elliott wave and the fractal approach. All right, only a bearish breakdown with hourly close below 40,185 that would invalidate today's intraday bullish bias to kickstart a deeper minor corrective decline scenario, re-exposing 39,560 followed by 39,145. Right, so that's for the Nikkei 225, that's for the Japan 225, pardon me. Now onwards, next will be the Germany 30 representing the German DAX. So the German 30 and the German DAX also pierced higher and hit our resistance level at this 24,110 before shaping a minor pullback during the US session and inching up higher again. So far there is no bearish divergence that's being seen on the hourly RSI on last Friday, indicating that lower risk of a bearish reversal or a deeper minor corrective pullback scenario. So first support level is a zone level to watch, which is close to last Friday US session low at 23,975 / 23,890. So this could be a potential pullback level to watch, given the fact that the hourly RSI is at the overbought level with risk of a minor pullback. So maximum pullback level will be my tightened pivotal short-term support level for today at 23,770. That's more significant. Why? Because that constitute with the minor range top of 24th of June and 25th of June that kick-started this minor corrective decline near the gap support before staging that impulsive up move. All right, and as well coincides with the 20-day moving average as well, which is coinciding at 23,770, making it a very critical inflection point. So that will be my tightened short-term pivotal support level for today instead of 23,975, which is not so significant. So 23,770 short-term tighten short-term pivotal support to maintain my intraday bullish bias on the Germany 30 above 24,260, potentially sees the next resistance level, which is also the new fresh all-time high for the Germany 30 at 24,560/600, which is also the Fibo extension level of 1.382, taken from the low of 19th of June. Only a bearish breakdown with an hourly close below 23,770 that would invalidate today's intraday bullish bias to kickstart a deeper minor corrective decline to revisit 23,510/440, which is coincided with the rising 50-day moving average before another bullish momentum takes shape. All right, because this 50-day moving average providing a good significant support in the previous sell-off that was being seen on 20th of June as well. So that that was actually during the onset of the Israel-Iran conflict at that point in time. But overall, the Germany 30 managed to survive. So which is the 50-day moving average. So once it retests at 23,510/440, that could be another form of bullish momentum, resurfacing back again based on its previous price action that react positively off it. So that's for the Germany 30. Next up will be the major US stock indices, starting with the US Wall Street 30. So like I mentioned, we got to respect the positive bullish momentum of the major US stock indices, despite they are climbing out a wall of worry. So from a technical analysis perspective, very likely since the low of 20th of June, right now we are in the process of undergoing this very strong extension in minor impulsive wave 3 movement based on the elliott wave perspective. So on last Friday, we have a resistance level at 40,020, which has already been met, hit over here. So given that it almost came down and hit this previous congestion area before shaping that V-shaped recovery. So with that, we will be using a Titan short-term pivotal support level for today at 43,550. So that also constitute with a 23.6% Fibo retracement taken from the start of this minor impulsive wave 3 sequence as well, very close to it. Okay, so with Titan short-term pivotal support at 43,550, we will still maintain our bullish bias on the Wall Street 30. Resistance level to watch 44,220, followed by 44,400/520, which is the 3.618 Fibo extension and the 1.382 from the previous time scale of the low of 23rd of May. And above it sees the next resistance coming in, which is the 4.236 extension taken from the low of 19th of June. That is at 44,820 level. All right, so if you look at the daily time frame chart, the Dow Jones Industrial Average still has some more room to go before hitting the fresh its current all-time high level at 45,100 that was printed previously in 29th of November 2024 and was retested in 31st July, very close, 31st of January this year, very closely. All right, so it still has some more room to go before hitting its fresh all-time high that was printed last year and in early January this year, very closely. Only a bearish breakdown and the hourly close below 43,550 that would invalidate today's intraday trend bullish bias to kickstart a minor corrective decline sequence, re-exposing 43,290/160, followed by 42,860 next, which is the 50% Fibo retracement of that wave 2 to the wave 4, right? Close to the 50% Fibo retracement. Right, so that's for the US Wall Street 30. Next up will be the S&P 500. So the S&P 500 also hit our resistance level at 6,175, 6,190. So that's a fresh new all-time high level that has already been made. So with that, first pullback support level to watch will be this bullish Marabuzu candlestick closing level at 6,175 that's being seen on last Friday. Today's Asia session is going to gap up, and the pivotal support level remains unchanged at 6,136, which was close to last Friday minor swing low where Trump threatened threat on Canada, and where it bounces off exactly at the pullback support level of this former minor ascending range resistance from the high of 29th of April. So very key inflection rebound point as well. So 6,136 tighten short-term, a rather tight short-term pivotal support level, maintain our intraday trend bullish bias on the SPX 500. Next resistance level to watch 6,250, followed by 6,290, which is the 0.3618 Fibo extension level from the low of 19th of June, and it continues to undergo this minor impulsive wave 3 sequence. Only a bearish breakdown below 6,136 will negate this bullish, outright bullish bias scenario to kickstart a minor corrective decline sequence on a more pronounced basis, exposing the next near-term support level at 6,110, followed by 6,070. Next, below it may retest the 20-day moving average at 6,050/6,030, which is also the overlap of that wave 1. All right, over here. So that's for the SPX 500. Lastly will be the Nasdaq 100. So Nasdaq 100 also hit our resistance level at 22,710. So with that, first support level to watch out for today will be the Marubozu candlestick of last Friday at 22,576. Pivotal support level 22,360, which is close to the minor swing low on last Friday after Trump's threat on Canada, and also close to, and also the pullback support of this former minor ascending range resistance now turns into a critical short-term support level. So 22,360 short-term pivotal support on the Nasdaq 100, maintaining our intraday trend bullish bias. After 22,710 sees 22,855 next. Above it exposes 23,190, which is a Fibo extension level, cluster level. The 3.618 Fibo extension taken from the low of 19th of June as it undergo this impulsive wave 3 sequence as well. Only a bearish breakdown and hourly close below 22,360 that would invalidate today's intraday direct bullish bias to kickstart a minor corrective decline sequence on a more pronounced basis, exposing the next support level to watch will be at 22,235, followed by 22,065. If it can't hold, it may slip it deeper towards 21,990, which is the rising 20-day moving average. And over here, 22,065 and 21,990 is a critical support zone, potentially for the bulls to actually restake their we call it authority if it comes to meet with this level, because right now very clearly the short-term bullish trend still remains intact as price action going to trade above the 20-day moving average. And from a crossover perspective, the 50-day moving average has a bullish crossover above the 200-day moving average as well. So overall, the bigger picture trend bias still remains on the bullish side of the story rather than the bearish side of the story for the Nasdaq 100. All right, that sum up the intraday technical outlook on the major stock indices. So let us now focus our attention to the commodities market very quickly, starting with Gold XAU/USD. So for Gold XAU/USD, we have a pivotal, we have a support level. On last Friday, we have a bearish bias at the 3,250 level. So the 3,250 already has been hit, and right now is attempt to reintegrate back above the medium-term ascending trend line that I have drawn from the low of 31st of December last year. And what's interesting, after the test of this 3,250, the hourly RSI starts to shape a bullish divergence over here, so indicating that downside momentum has eased off. So with this positive observation that's being seen right now in Gold XAU/USD, there could be a chance or higher chance of a potential minor bounce taking shape today. So from an intraday perspective, we will flip to a bullish bias for today. 3,250 short-term pivotal support level. First resistance zone to watch out for will be 3,300, followed by 3,315, which is also close to the 50-day moving average as well. Let me put it in writing. 315 above 3,315 sees 3,346 coming in next, which is the high that got rejected on last Thursday that kickstart this minor slide, and also confluence with the 20-day moving average as well. Only a bearish breakdown and an hourly close below 3,250 that will invalidate the minor bounce scenario to see the extension of this corrective decline, exposing the next support in the first step at 3205, which is the minor swing low area of 19th of May and 20th of May. If 3205 can't hold, it may slip it down further to 3155, which is the minor swing low of 16th of May over here. So that's for Gold XAU/USD, flipping to a short-term intraday bullish bias for a potential minor bounce using 32.50 as my short-term pivotal support level. Lastly will be the West Texas oil. So on West Texas oil, on last week, we have a bullish bias for a corrective bounce to take shape. And the corrective bounce almost hit our first resistance level at 66.67. Then thereafter, the hourly RSI shaped a bearish breakdown below this parallel ascending trend line, and as well as breaking down below the 50 level mark. So indicating that the corrective bounce may not have momentum to push up further beyond 67.67 to retest the critical zone of 69.15/60.60. So with that, we will flip to a bearish bias for today using 67.67 as my short-term pivotal resistance level. First support level to watch will be 65.05, which is the 50-day moving average. Breaking down below 64.05, pardon me, breaking down below 64.05 with confluence with the 50-day moving average exposes the next near-term support level at 62.50, which is the minor swing low area of 3rd of June and 4th of June. Only a bullish breakout above 67.67 will negate today's bearish bias to see a squeeze up to revisit the critical zone of 69.50/70.60 that constitute with the 200-day moving average, and as well as the former major descending resistance from 28th of September 2023 high that previously see a bullish breakout. Then thereafter, this bullish breakout is a failed bullish breakout after breaking back below it, where the Iran-Israel conflict has started to subside. Right, so that's for West Texas crude oil, and that also sum up the intraday technical outlook on the major cross asset classes. So before we go quickly, let's take a look at the economic calendar. What are the key data to look out for today? So during the start of the European session, we do have Germany retail sales at 2 p.m. Singapore time. So that could potentially influence the euro dollar, the euro crosses rate, and as well as the Germany 30 index. Then thereafter will be a rather quiet session. All right, so we have 8 p.m. We do have Germany inflation rate preliminary figure coming out for the month of June at 8 p.m. Singapore time. So that could also potentially influence the euro dollar, the euro crosses, and the Germany 30 index. So that's 8 p.m. Singapore time. And at 10 p.m. Singapore time, we have Fed Bostic speech over here. All right, which is considered as a Fed speak. All right, so that sum up the intraday. We call it that sum up today's daily dose of market insights. I'm Kelvin here signing off. I wish you a great day ahead, and we shall speak again tomorrow. Thank you.